let's take a look at Airbus. Airbus is a large aircraft manufacturer. If you flew in the past, you probably flew on an Airbus or a Boeing, one of those two. Those are the two biggest. Now, we want to find out the intrinsic value of the company, and we do that by discounting the future free cash flows and then figuring out what that is in today's dollars. Now let's see, what's the market cap? 46.4 billion. And the stock price is 14.73. I'm actually converting the market cap to euros. That's why it's not 46 in here, it's 42, because the financials are in euros. So I have the free cash flow input, the net income input, and the revenue input. And you can see in year 3 they had a big drop in free cash flow. It could have been a large expenditure because a company like Airbus has massive expenses, sometimes big one-time expenses. And that's why we use free cash flow to figure out the value of a company, because it's the actual cash that's left over after each accounting period. And if you own a small business, you'd probably use net income. I know I do in my small business. And the reason we don't when we value a company is because net income is based on an accrual accounting, not cash accounting. And the numbers don't always fit each year. There's depreciation, there's amortization, there's losses, there's a lot of accounting things going on. So free cash flow is the best indicator of the company. Now, in 2019, as you can see, Airbus had a loss. Even though they had their best revenue year, they had a loss. And it wasn't their expenses. And I'll show you on the income statement. So you see the top line revenue is 70 billion. Last year was 63 billion, and the prior years it was in the 60s. And the cost of revenue is not that much more. It's actually less than it was in 2016. So they had the highest gross profit they've ever had in 2019. Yet they posted a loss of negative 1.4 billion. And their income, let me explain why. And it's really going to mess up the model, because the way you have a good discounted cash flow model is you have a company with consistent net income and fairly consistent numbers. If you have companies like startups or these large tech companies with all these crazy changes year to year, you can't estimate the future of a company because you're using prior information. In our case, we're using the prior 4 years. You go back as far as you want, but if you go back too far, it might not be as relevant. So let's talk about this negative 1 billion. It's actually, the company was penalized 3.6 billion euros related to a corruption probe settlement. So that's a one-time thing. That's probably not going to happen again. And that's a lot of money, 3.6 billion euros. These numbers are in euros. So let's change this, and we could do conservative. We don't have to add 3.6 billion. Let's add like 2.5 billion. So let's just change this number to a billion. And I'll show you why. This is Airbus's net income historically. And you could see this year was the only year they had a negative. Every year was positive. So I don't think this is too aggressive of an approach, because I would expect their net income to continue being positive, not having these legal issues. Okay, so now let's move forward. So this is what you have to do sometimes as an analyst to identify whether the inputs in your model are correct. And let's see, interest expense, 339 million. And now the short-term debt is 1.7 billion, and this is debt that's due within a year. And we need this info because we need to figure out what we have to discount the future free cash flow by, because every company has their own unique discount rate based off of their borrowings and their cost of capital. Let's get the beta of 1.6. Sorry, let's finish out. What's the income before tax? That's $1 billion. And the income tax see, there's the problem. It was that year they had that big legal settlement. So you can't use that to figure out the effective tax rate. Let's use the year before, because the effective tax rate should be pretty similar year to year unless something crazy happens, like a big lawsuit. So let's see what it was last year and just use that tax rate. So the effective tax rate is about 30%. That looks about right. So even though they pay 3.95% on their debt, they do get a tax deduction on that payment of 29.73%. So their cost of debt is 2.77%. Now let's find out the cost of equity. And equity always costs more because it's a much more risky investment than debt. Debt holders are higher on a capital structure, so they get money before the equity holders. So the cost of equity is 14.68%, cost of debt is 2.77%, and when we blend that with the weight of the debt and the weight of the equity, we get a WACC, a weighted average cost of capital, of 12.69%. So now let's discount their future free cash flow by that amount. And this is up here, the free cash flow estimate based off of historical information. And then we present value that based off of the discount rate we just calculated. And we get a value of the company of 18.7 billion. That's hard to read because it's not in the same. Yeah, 18.7 billion. And if we divide it by the number of shares outstanding, the share price is $6.48. That's the intrinsic value of the share price. And it's trading at a pretty significant premium. Now, why is that? Why is the intrinsic value so much lower than the stock price? Because the stock price is way high for a while, about 40, but it did drop from coronavirus closer to intrinsic value. And there's a lot of reasons why a stock may trade above. Some companies don't make money, so obviously their stock is trading way above intrinsic value if they're negative calculation. But people see the future of companies as being more valuable than what they reported in their financials in the past. And that's what you have to decide. You have to look at the competitors, the industry, the environment, a lot of things. So let me know what you think. Leave a comment. Let me know if you want me to do another company. I'd be happy to run a cash flow model on another company. Thanks for watching.